Good evening. I'm Robert Colvile, Director of the Centre for Policy Studies, and I'm privileged to welcome Sir John Redwood to this Going for Growth webinar. So to provide a bit of context, the Going for Growth series was something we set up last year with the generous support of John Mills to address the fundamental economic problem in this country, which is that growth rates are sort of stagnant and likely to remain so compared with their long-run historical average. This is not just a British problem, as Dan Bisa-Moyo pointed out in the first of these lectures. It's something that more general, and it requires, we think, more imaginative economic solutions than we've seen than we're currently seeing. It's wonderful to have Sir John contributing to this series. He is a very, very old friend of the CPS. His pioneering work for us on privatisation set the groundwork for much of the Thatcher agenda, at which point he went into Downing Street to run the number 10 policy unit. In fact, I noticed, rooting through the archives, that he also co-wrote a paper on on how we should reform the NHS with Oliver Letwin, which gives you some idea of how things have changed in the intervening period. But I'm also really keen that he's taken central banking as the sort of subject of his lecture. One of the sort of strange things for me, ever since I became involved in politics, is that back in 1979, the Thatcher prescription for fixing the economy was, by and large, a monetary one. Monetary policy was at the absolute core of the political debate. And one of the unintended, or maybe even intended, side effects of the reforms in 1997 has been to completely take monetary policy, which is which should be an equal pillar to fiscal policy, out of the political debate. I was just doing some number crunching before we started. If you look in the most recent 4 Conservative Party manifestos from 2010, 2015, 2017, 2019, you will find the word interest rates about 4 times. You will find the word Bank of England about 4 times. You will not find the word monetary. You will not find the word quantitative easing. You will not find QE. Essentially, the number of politicians and the number of commentators who actually care about this stuff is very small, and so John is one of them. John McDonnell on the Labour side was actually another. But it's become the province of a very small and quite technocratic elite. And Sir John argued in the lecture in his original lecture, which would have been delivered if we'd actually all been able to be in the same room together, that this elite has not made the right decisions. So I'll ask Sir John to outline his thoughts, and then hopefully address the situation we find ourselves in, obviously, with coronavirus. If you have any questions, you can either put them into the chat down at the bottom of the screen, or there's a separate Q&A forum. You can either ask questions in your own name or anonymously. I've got a few which have already been submitted. Alternatively, if we want to get extremely technically advanced, you can raise your hand in the participants panel, and if I notice it, I can then unmute you and you can actually ask your question in person. I think it might be easier just to do it typed out, but if you want to actually hear your own voice, then we can do it that way as well. But let me start by handing over to Sir John.
Well, thank you, Robert. You're right to remind us that we had great battles on monetary and economic policy in the 1970s and 1980s, which ushered in the Thatcher period of reform and good growth and the creation of a lot of jobs, particularly in the private sector, in those Thatcher years. And the arguments then were about whether banks had been too casual in the amount of credit they had extended, allowing too much inflation, and whether inflation was itself extremely damaging to economic progress. The case of my paper is that the governments of my adult lifetime since the 1970s have been largely determined in their success by monetary policy, with additions of general economic policy. The 1970s Labour government went down to a disastrous defeat because it made a mess of both money and government borrowing and government economic management. But quite a big element of it was a monetary problem in the 1970s, a time, of course, when governments were still responsible for monetary policy as well as economic policy. And they were out of office for many years because the the Thatcher governments managed to put together economic revival and recovery with rather better monetary management. That Conservative government under John Major then went down to a devastating defeat because of a major monetary disaster. And that was that the establishment of the United Kingdom persuaded the then Conservative government to join the European exchange rate mechanism. And that mechanism gave us a dreadful boom and bust. We had a big credit explosion because the exchange rate dictated that we had to keep interest rates low and print a lot of money. And then the bank had to reverse its actions and tighten money, put up interest rates, and reduce the amount of credit and money in circulation in order to try and keep the pound up. And that created a recession. So we had a dreadful boom, bust, and that meant the Conservatives were out of office for a very long time because they lost their very important reputation for economic management. We then had quite a long period when the Labour Party presided over reasonable economic progress, ironically drawing on the economic plans and spending plans and borrowing plans of the outgoing Conservative government. But towards the end of the Labour period, they expanded too much. They allowed an enormous monetary and credit boom, and then they allowed the central bank and the commercial banks to put on the brakes far too severely. And so we had an even bigger boom bust at the end of the Labour years than we had, thanks to the exchange rate mechanism, at the end of the Conservative years. So the two defining moments which change governments fundamentally and lead to big general election defeats for the ruling parties are brought about primarily by big monetary mistakes. And then since 2010, we've had reasonable progress, but there have been difficult arguments over whether the Bank of England from 2017 to 2019 was pursuing too tough a policy, both its Financial Policy Committee restricting the amount of credit for things like homes and cars at a time when arguably we needed to allow more people to buy them, and the monetary policy more narrowly defined by putting up interest rates and throttling back the amount of monetary growth, which meant that the economy performed rather poorly. This has been ruled out from political debate by a very strange doctrine. And the doctrine is that central banks are independent. This was never true, and it can never be true. In a democracy, the elected government has to take responsibility for economic success or economic failure. Monetary policy is a very important part of the general economic policy mix. And if monetary policy starts to go wrong, then either the government intervenes with the central bank or the government goes down to defeat because big mistakes are made. And we see this throughout the free world. A number of countries have said they have independent central banks, but whenever there is a crisis or there is a big disagreement over economic and monetary policy, then of course the elected government prevails. We saw the Labour elected government during the banking crisis overruling the Bank of England over interest rates quite correctly because they were keeping them too high. The finance ministers of the leading countries met together and agreed a concerted interest rate reduction. We saw the German central bank, famously said to be independent for quite a long time, overruled both on the merger of the two Germanys and their currencies, and then overruled again over the abolition of the currency itself. So when it came to big political decisions, of course, the government made the call and the central bank did not. And in the United States of America, it's always been accepted that the Fed and the administration work very closely together. Now, today, to update the story, there may be people who still think central banks are independent, but it is quite clear from all the statements of the European Central Bank, the Federal Reserve Board, the Bank of England and the Bank of Japan, let alone the Bank of China, that these central banks are working very closely with the treasuries and governments of their countries, as well they might. They understand there is a massive deflationary, recessionary crisis brought on by the responses to COVID-19. And so they are working together, and the central banks are injecting money and getting interest rates down, and they're looking to the treasuries and governments to inject cash through programs of support. So I'm happy today in this one respect that we now have living proof that there isn't an independent central bank at times of change or times of important decisions. And I'm pleased to report to the audience that I think now the central banks are working correctly and very closely with elected governments to to try and get a combined policy which makes sense.
Sorry, I muted myself to prevent my 5-year-old from intruding on the discussion. So two questions which follow from that. Then, I mean, what is the thing? What is the policy response? What should be the policy response to this current immediate disaster? But then, on a longer term basis, how do you if you want central banks to do their jobs better, so the other part of your thesis, sorry for those who haven't read the essay, is not just that central banks cannot be independent, but that, as you say, they have made a sequence of major mistakes while being independent or not. I mean, so there's two questions like, what should central banks do now, and secondly, how should that be? How should the relationship between banks and government in this country change in order that they can do their jobs better?
I think the new governor of the Bank of England is a welcome breath of fresh air and has made very important immediate changes, as he had to do. But I trust the Bank of England will learn from its experiences over the years. I think there were mistakes in the secondary banking crash and the property crash of the early 1970s, which related to central bank control of commercial banks, as well as the mistakes of commercial banks themselves. There were clearly gross policy errors over the exchange rate mechanism when the central bank strongly recommended that, as well as other people in the society. And then there were obviously big mistakes in the great banking crash. They weren't all the mistakes of the commercial banks. They were allowed to overextend their balance sheets. And the issue is, why didn't the central bank and other central banks rein them in and control them more quickly? And that once the thing got out of control, why did they take such draconian action in a way which undermined the solvency of banks and the stability of the whole system and led to extraordinary measures to pull back from the brink? So I hope there will be a general learning exercise from these errors. And I speak as someone who's been providing commentary on these things over the years. And on 2 of those 3 crises, I'm not jobbing backwards. At the time, there were some of us who were saying the exchange rate mechanism can't possibly work for the United Kingdom. It will lead to boom or bust, or indeed even boom and bust. And there were many people, including all the opposition parties in the early 2000s, saying that the credit explosion was getting too great and it needed to be reined in earlier. And then there were a few of us during the crisis saying that the response of the bank is too extreme. So what I want to happen is learning from these obvious mistakes, also learning from the German mistakes, where I think in practice the once independent German central bank made good economic calls on Ostmark-Deutschmark reconciliation and maybe on joining the euro, but it was overruled for political reasons. Well, that's a matter for German public debate. It's an interesting point in my argument about, can you have a truly independent bank? So what now has to happen is that the central banks have to go on making very difficult judgments. Very difficult because the numbers are off the chart. They're off anything we've experienced before. Those of us who've lived through 2 or 3 recessions are used to, in a recession, maybe an economy falling by 2 or 3%, or maybe a little bit more. But we're talking about double-figure percentages of collapse here, because you're not talking about a range of companies losing 10, 20, 30% of their revenue in a downturn. You're talking about maybe a fifth of major economies losing all their revenue overnight and not being sure how long they have to run without revenue. So the proportionate response has to be that much bigger, both from governments to provide grant aid and assistance to those who are not allowed to work, companies and individuals, and the central banks who have to provide the liquidity and the credit so that there can be cheap loans for all those who have a future and need to be kept going by borrowing as well as by grant. And it makes it very clear it has to be the government and the central bank working together, because they've got to work out an optimum mix of grant to be paid for by all taxpayers and loans to be paid back by companies that are able to do so in due course, that gets the best answer in terms of recovery. Now, well, what's the best policy? Well, the best policy, of course, is to get over this as quickly as possible. We're all desperately hoping that the health policy is very successful very quickly, because the sooner we get people back to work, the less the damage that is done, the easier it is to have a recovery. The longer this thing lingers on and the restrictions remain, the more we have to answer these extremely difficult questions of what is the balance between lending and grant, and how is that money going to be created and accounted for and ultimately paid for.
Yeah, but it sounds like you're not, at the moment you're not worried about the debt as a percentage of GDP, or however many hundreds of billions are being created by QE. That's the sort of problem for next year, if you see what I mean.
Well, I think we need to be conscious of what we're doing, and yes, I'm watching the numbers very carefully because they are eye-popping. They're much more eye-popping in the United States of America, where the Fed response has been even more vigorous than the Bank of England or the European Central Bank. And so we do need to watch the numbers. But yes, in the short term, I'm very much a fan of the policy, given the dreadful circumstances we're in, of keeping markets liquid, of keeping interest rates low, of making sure there's cheap credit available for all those who have reasonable businesses for the future. And I'm very much in favour of the furlough schemes so that jobs can be kept going and the taxpayers can make a contribution to the pay, because it's much easier to rescue the situation if companies have a workforce awaiting the return to work and they don't have to pay the full bills over the period when they had no revenue. But that argues for this not going on too long. So I'm urging the government to find safe ways of getting more people back to work. And I think we are needing to develop new models of work for this difficult period. And that has to be more working from home, more remote technology being used, as we are doing today for this seminar. Businesses can do this for profitable activities. There has to be much more online, much more digital, much more artificial intelligence. Businesses are going to adapt that, and social distancing has to be observed, and better hygiene standards and so forth. And all those things are now being worked on by private enterprise companies. And the sooner we can get more people back to work in as safe a manner as possible, the better. Because what is very clear is it's not sustainable to go on for month after month with a fifth or more of your economy completely locked down and over half of your economy with very little revenue and a massive gap between the revenue coming in and the huge costs going out.
Yes, I mean we've done some work at the CPS, and if the OBR scenario of 3 months of lockdown and then 3 months of partial lockdown is accurate, then we're looking at a deficit of 300 billion this year, which is 50 billion of which is existing borrowing, the rest of which is split half and half between the direct costs of the bailout and the costs and then lost tax revenue and all the rest of it. And that's not to argue that we shouldn't be doing this. As you say, you need to be doing this, but in the background there is this enormous bill ticking up.
Yes. And if that's the end of it, I think that is financeable, and that is the best you can do in the circumstances. And I think you do need to be pretty generous from the centre when you've got a lot of companies and individuals who are prevented by law from working. This is not that they've made some mistake or that maybe their business model was faulty. They literally, for the greater public good, are told they mustn't do what they normally do. They mustn't earn their living. So we need to be fairly generous and get the money out to them so that they have a business that they can carry on, they have a job they can go back to, which makes recovery that much easier. And if we don't do that, then the bill would be much bigger, of course. Because if the state was mean at this stage, you'll have more bankruptcies, more job losses, many more people on unemployment, much less to recover. And so you'll have to live for a lot longer with mass unemployment and a very depleted stock of good companies, which would not be a good answer. Changing
the subject slightly, in terms of the central banking point, is there are there countries which do this well, in your opinion, either in terms of the relationship between the banks and the politicians, or just where in countries where that care about monetary policy, or where it's a topic of debate in the way that it should be?
I think the United States of America is a bit better, because I think there is an understanding that there is a lively exchange, particularly with a president like President Trump, between the executive branch and the central bank, and the central bank doesn't get too worried that its so-called independence is being challenged. I think in any good democracy, there is reasonable political challenge of the central bank, and there has to be strong central banking so that when they are pretty sure they're right technically, they stick to their guns and are not unduly influenced by politicians who want to try and time something for an electoral cycle rather than for an economic reason, and that can come out in the public debate. So I think in the fairly open debate, the United States of America that works reasonably well, and the Fed has always accepted it has a twin policy objective. It's not just an objective to keep inflation down, but it's also an objective to keep America at work and to promote decent growth. So that I think works quite well. A country that has many features of its political system that I don't admire, but I think has an understanding relationship between central bank and government is China. Maybe the Chinese government has too much power over the central bank. But there is certainly a wish for the central bank and the government to work in very close harmony. And the Chinese monetary policy has been a bit more successful in recent years than some of the Western monetary policies.
Right. Well, the temptation to use the incredibly powerful tools on my screen is almost irresistible, and I have questions coming in from multiple directions. Let's start with David Triggs, who has raised his hand. And I can hit the button saying allow to talk. David, if you're still there. Oh, there we go. David, hang on, there we go.
Lovely. Thank you very much indeed, Robert, and thank you very much, John, for your dissertations thus far. You've mentioned specifically at the very beginning the tragedy of divorcing monetary policy from fiscal policy. And you've spoken quite a lot about monetary policy, but you've actually made very little link thus far with fiscal policy. And so I'd first of all like you to elaborate on how the fiscal policy might be adjusted to remedy the problems that we've got. But in that context, I'd like to observe first of all that the calamity that we're currently suffering has not actually destroyed any real wealth. No properties, no factories, no tools, no food, no fields have actually been lost during this crisis. And most of the resolution seems to be revolving around monetary solution, i.e. creating new money in order to enable people to meet their creditors. Whereas what in fact has been physically evident is that our real needs have simply been for care and attention through the health service and food and essential real products delivered to households. And linked with that, the problem of the money supply that we saw in 2007-8 and earlier has been the granting of mortgages against property and land values and assets, essentially, money lending against investment, not in production, but in property.
David, sorry, we're going to have to wind it there, but I think
I've probably said more than enough.
Right, well, should I try and tackle some of that?
Yeah.
I fear there's going to be a wave of capital destruction as we live through this crisis. Of course, you see the monetary and banking issues first because they are fastest moving and the markets adjust and highlight those first. But I think you're going to see, for example, a retirement of an awful lot of older aeroplanes and reduction in capacity in the aviation industry. You're going to see a truncation of other tourist and travel activities with the reduction of capital. I think in the property sector, you're going to see some very profound effects. We were already seeing a trend to value industrial and warehouse type property more highly because the online competitors in the retail area needed much more space, and to get some downward movements in rents and property values for high street shops and other retail outlets. And I think you're going to see an acceleration of that trend because this is a very major stimulus to online versus conventional shop-based retailing. And they're just two examples of big capital stocks. In the case of aviation, massively expensive machines, and in the case of retail, very expensive shop properties, where you are going to see a writing off and a reduction of the capital stock. Now, you asked, how does monetary and fiscal policy fit together? Well, I think it's becoming very clear as you see the response of the UK, the US, the Europeans and others to this problem. If you take the United Kingdom, the government is going to spend quite a lot of our money, rightly in my view, on subsidising employment and trying to keep companies and individuals going at a time when they can't earn any income. And so that, as Robert has reminded us, is going to boost the borrowing requirement very considerably. So the fiscal policy will be a lot looser. There will be much more borrowing. It would be quite wrong to try and cover that extraordinary expenditure by taxation, because the last thing you want is tax rises when the private sector is squeezed for cash by the general controls. So it's going to have to be borrowed. And then the Bank of England, very helpfully, has cut interest rates and has announced that it's going to buy up to 200 billion of government debt around the time when the government needs to issue all this extra debt in order to pay these bills. So that is a very good example of the harmony between fiscal and monetary policy. And indeed, just to go further and make sure that it works sensibly, the Bank of England and the Treasury have helpfully agreed that in the short term, the Treasury will be underwritten with a Bank of England overdraft were there to be any delays in actually raising the money from the market. So I think we're seeing under these extreme conditions where you've got the danger of far too dramatic a deflation, the removal of large amounts of income and spending power and the capacity to work from the economy, and with the oil price collapsing and other international prices signaling that in the short term it's deflation and disinflation which is the problem. In those circumstances, you need both monetary and fiscal policy working together, both boosting an economy which is being damaged in a quite unprecedented way. As we start to come out of it, then both the government and the Bank of England have to make more difficult decisions, as I was implying, over the pace at which they reduce that extraordinary large injection of cash from both sources.
And so I'm sorry, David, we're going to move on because we've got quite a lot of people who've asked questions partly beforehand as well. So two linked questions really, one from John May just now on the Q&A and one from Peter Lloyd of Royal Holloway, which came in beforehand. So John's question is, assuming government debt does rise by approximately 300 billion, how much of this could and should be funded by long-term gilts, and what appetite is there for this at acceptable interest rates? And a slightly more dramatic and international version of the same question from Peter, pointing out that the Italian government has just announced that it expects 10% of GDP deficit this year. It expects debt to rise to 155.7% of GDP from 134%. You know, this is Argentina sort of sovereign bond. This is run on the currency status normally. Eurozone debt yields have risen modestly, but don't seem to be badly affected by this deterioration. Do you believe that central bank debt purposes are distorting the sovereign bond markets, and where might the increased risk show up? So I'm sort of taking these together because one in the UK context, one internationally, but essentially, at what point the market's patience run out, or what effect is that massive bond buying you referred to going to have on the system more broadly?
Well, in the case of the United Kingdom, yes, I think that money should be borrowed, and I think it should be borrowed reasonably long term, because I don't think it's right to say that we have to repay all this in the next year or two. This is, we hope, a very rare event, and so it's perfectly reasonable to spread it over a period of years with appropriate length of debt. And given how low interest rates are at the moment, I think it's a strong argument for funding it as long as possible. The UK does tend to fund its debt on average longer than a lot of the continental countries have done. And this is a good time, I think, to fund it as long as possible. The bank and the Treasury tend to like to offer a range of maturities because there are different types of buyers in the market, and it probably makes the big issue program easier if you have a range of maturities out there for the different kinds of buyers. But the longer the better, as far as I can see, given the interest rates and the reason for it, that this isn't a permanent annual increase in debt. We trust it's a one-off to deal with this crisis. The issue of Italy is much more difficult because, of course, there's a huge difference between a country which has sovereign powers over the issue of its own currency and sovereign powers over its own treasury, like the United Kingdom or Japan or the United States of America, and a country which has given away its powers to create its own money and shares a currency with somebody else. And so there are complications which we don't have to face. If you look at the Japanese example, and I trust we're not all going to go the way of Japan in terms of debt and money creation, you can see there that they had a really bad inflationary blow-off in assets in particular at the end of the 1980s. And ever since, they've been living in a world where their state borrows very large sums of money. It's managed to borrow those huge sums of money at around zero interest rates, and it has sustained those zero interest rates by its central bank buying up very large quantities of its debt. So the central bank owns around half of the state debt, but the state debt is something like 250% of GDP. But when you're borrowing at 0% for out to 10 years, it's not much of a burden on taxpayers. And so it's proved to be remarkably stable. But I think there are lots of special circumstances which mean America and Britain aren't like Japan in lots of ways. We're not going to emulate that. But it does show you that what looks absurd, the government borrowing huge sums of money at zero interest, are not necessarily absurd depending on the policy context. But you can't do that if you're Italy, because Italy has to apply the strict borrowing rules and budget rules of the Euro scheme, because the surplus countries, particularly Germany and the Netherlands, doesn't wish to see Italy borrowing very large sums of money at very low interest rates, thanks to the credit rating of Germany and Netherlands and their input into the euro. And so there will be tensions, I'm afraid, and Italy will be under restrictions and demands from the European Union not to allow its deficit to balloon too much, because the central bank won't want to monetize all of that deficit.
I mean, one option, obviously, is when faced with significant debts, is to allow inflation to gently not let rip, but to increase it. I mean, is that something you'd be happy with, or do you think that way lie the old familiar dangers?
No, I'm not happy with that at all, and that's why, because the numbers are so huge, and this is so outside anybody's experience, it is going to require very difficult judgments by those making these decisions and those that's trying to help them over the pace at which you go back to something more like normal, both on levels of government borrowing and on levels of central bank money creation and bond purchasing. The two really go together. At the moment, we're still in the middle of fighting a massive deflation and disinflation. So I'm quite relaxed that these numbers are so large, and they need to be very large to get us through. But when we begin to see the pace of the recovery, then more difficult decisions will have to be made about how you throttle that back before it becomes inflationary, because it could become very inflationary if you added to the money that the central bank was creating and the extra money that the government was spending, a big surge in private credit and money creation through the banks as well. Then you could have fast inflation, and we need to head that off before it occurs.
And I'm going to see what pushing the answer live button does to this, which potentially, I don't know whether it means that the person who asked it can speak or whether it shows up on screens. But James Anderson wants to know what fiscal reforms we should be looking at. For example, providing employers with more flexibility to place staff on short-term working, paying unemployment benefits. For the days not worked, has been in the case in Switzerland. I mean, are there any? Obviously there are lots of schemes in place already. What's your impression? Are there any particular ones that you think should be amended, or gaps that need to be filled?
Yeah, I'm on the generous side in this argument, because I think this is an extraordinary one-off thing, and we trust that this intense period of crisis is relatively short-lived. So I think we do have to put a lot of money out there to keep people going, to prevent a complete collapse in demand, and to keep companies and small businesses in being against the recovery. So I want to be generous. I hope the government will be, has been pretty generous. How would it improve it? Well, I think it needs to look at directors of small companies who earn their living from their shareholding, which is in a company they work in full time, and they're not getting particularly good treatment. I think the self-employed generally might need faster and more generous treatment than they're getting.
Well, Rishi Sunak has been quite clear that they're sort of first in line to be clobbered when the tax rises come.
Well, again, I wouldn't do that. And I think it's quite wrong to threaten anyone with tax rises at the moment. I think we need to help them through a time when, through no fault of their own, their income has disappeared altogether or been badly reduced. And we need to get them out the other side because we need them to contribute. So around 5 million self-employed people in this country, great success of successive governments creating conditions in which that could happen, from standing start in the 70s and 80s where we didn't have nearly enough people working for themselves and enough small businesses. We need to look after them and make sure they're around and willing and energetic to crank things up again as soon as we come out the other side. So no, they shouldn't be attacked. They should be assisted, and the self-employed should get at least as generous assistance as those in employment in large companies. And of course, many people in the private sector don't get anything like the support that we get in the public sector, those of us who are privileged to have public sector jobs where we are paid anyway, and where now I'm pleased to say MPs can go about their job suitably adjusted for the new conditions. And I hope we're going to be a model for many other people that we've had to adapt our workplace, which is based upon bringing a lot of people together and encouraging them to interact as strongly and as closely with each other as possible. We're having to change all that. We're managing to do that. I think we need to work away at all the other workplaces in the country, as I'm sure many of the employers wish to do, and make it safer for people so that we can get them back to earning an income. Because I keep coming back to this point, keep stressing it's such an obvious point. We cannot afford to have half the country not working for a very long period of time. It's just not possible to sustain normal living standards or anything like them if you go on like that.
Yes, I made this point in the Times quite early in the crisis when Corbyn said this has sort of vindicated his position, and actually it's sort of vindicated the importance of the private sector, because we're now seeing what happens if you shut the private sector down, and the extent of the economic heavy lifting becomes dramatically apparent.
Well, you can only afford the great health service we want and do support by having a growing and successful private sector. And the health service needs more money, it needs decent salaries and many good people working in it. And to sustain that, we need a flourishing and growing private sector. We were just getting to that point again, where after years of toil and tribulation from the previous crisis, we were beginning to grow the economy a bit faster and things were beginning to work. We could afford a bit more. We don't want to put that all on the back burner again. So that is another argument for getting us through this as quickly as possible and having income and wealth creating sectors flourishing again.
And I mean, a sort of completely a sideways question, but you're obviously one of the, a leading advocate of Brexit. Do you think, but, a lot of voices are saying, that we should extend for 6 months or a year because business, to avoid having sort of two shocks in succession for businesses. I'm just wondering whether you have a view on that. I've heard various different.
I think it's quite wrong. I think this has underscored the arguments for getting on with it, and I think it's also shown that the real risks out there that people should have been worrying about were completely different from the alleged risks of Brexit. I mean, I've recently written a piece on the motor industry because the motor industry often figured prominently in the Brexit debates, and I was constantly being told that people like me were going to do damage to the motor industry because they seem to think that somehow supply chains would be interrupted if we left without a trade agreement. I never bought that. Around a quarter of the motor industry's components today come in from non-EU sources and they get through the borders perfectly well. And the supply chains are not disrupted if everything has to come through a border where we're no longer a member of the EU customs union. It will all work fine. So I always thought that was grossly misleading. But what, of course, is deeply damaging to the motor industry is the policies that have just been pursued. First of all, the green anti-petrol diesel policies, which really hit the industry very badly before the virus hit, and then the virus finished it off, closed practically every car factory in Europe, and has left the industry with a great gaping hole in its revenues.
So switching topics slightly, we've had two sort of overlapping questions in the Q&A, and please do keep them coming. One from Peter Lloyd and one from Tom Clockersy, who's our head of tax at the CPS, and therefore a bit of a monetary policy geek, as you'd hope someone with that job would be. So Peter says, you made some strong points in the essay about technocratic decision-making versus political decision-making. Do we need politicians to generally hide less behind these technical experts and explain better why decisions have to be political? And Tom's view is slightly different. Is that you've contrasted two views of discretionary monetary policy. One in the different poles, but one in which the central bank does its own thing, and another in which it works with elected policymakers. But a lot of discussion among free market monetary economists in the US, especially, is about monetary rules. The Taylor rule, for example, being to sort of automate monetary policy and try and take the biases and prejudices of individuals out of it. I mean, what's your view on both of those? Should politicians take more responsibility for monetary policy, and should we just try and take politicians and sort of biases out of it altogether?
Well, as I've explained, politicians do take responsibility for monetary policy, even when they deny they do and say that it's settled by independent people, because we've seen major changes of government at the end of the 70s Labour era, at the end of the Tory ERM era, and then at the end of the Labour banking crash era, when the governments were destroyed in no small measure because of major errors in monetary and banking policy, where the public decided that the blame did have to rest ultimately with the Prime Minister and the Chancellor of the day, even though they had trusted quite a lot of independent judgment by the central bank. So I don't think you can duck out from the responsibility. And I don't think it helps to say politicians making political judgments. When I was a government minister, I was very conscious. I was charged with duties as a government minister. So I wasn't making decisions in the interests of the Conservative Party as a government minister. I had to think about the wider national interest. I had to listen to a large number of lobby groups and people who disagreed with me as well as people who agreed with me. And I had to try and come to a fair judgment about what was in the general public interest. And I think successful prime ministers and leaders are the ones who reach out beyond narrow party interest, understand the public interest, and find answers that work for more of the people, more of the time. And that must include making judgments about how to respond to the technical advice of all sorts of people. And the very difficult decisions which the Prime Minister and the top team have got to make shortly about how and when to relax the controls is just such a case in point. Of course, they'll have lots of good medical advice and scientific advice and so forth, but in the end, only they can make those judgments, because somebody has to make a judgment and take a risk. There is no perfect scientific answer. No scientist can tell you for sure what controls will guarantee that more people don't die and so forth. It's a judgment. And the politicians have to add in all the economic advice coming from the bank and the Treasury and others and from business, which is pointing in a different direction. And they have to make a judgment of what is best in the public interest. So that is how I think it has to be done.
And on Tom's point about the Taylor rule, for example?
Well, I'm suspicious that there is a simple answer which allows you to do these things on autopilot. And I don't think you'll ever find one that always gets it right. And you certainly won't ever find one that there is a sufficient political consensus over to keep it in place for a realistically long period of time to give it a good run. And
mind you, we've had our current inflation targeting rule in place since 1997. I mean, is that still fit for purpose?
Well, it's a guide, but as we've just been describing, the inflation target has coexisted with some really big howlers in economic policy. So it hasn't been flawless by any means. It's not one that I would change. I think the 2% target is accepted around the world. It's a perfectly good guide, but it doesn't tell the Monetary Policy Committee and or the Treasury how to do its job, because you can have lots of arguments about what are the appropriate actions to hit 2%. Now, let me mention another piece of economic theory, which I think has not been particularly helpful in the way the bank and the Treasury and others have looked at our economy in recent years. And that is that they have had this idea of something called national capacity. And they think they know whether we're close to full capacity working or not in our country. And then if they judge we are close to full capacity, they put interest rates up and try and throttle back credit because they think it's going to be inflationary. And if they think we're too far below full capacity, then they're prepared to do the opposite. Now, I don't think that's worked at all, because I don't think the world is like that. We have a very open economy. where about a third of our economy is internationally traded, and where we've invited in a large number of people to take lower paid jobs, which has tended to keep wage inflation down, and where we've imported a lot of goods and services whenever we haven't been able to make enough or produce enough for ourselves. And so it hasn't been as inflationary as they thought it was going to be on their doctrine of national capacity, because our open economy has discovered lots of ways of keeping the price level and the wage level down by using the internationally traded sector.
So a couple of questions. Supportive of your position that Brexit shouldn't be delayed. Malcolm Matson says, how can the UK use the current economic crisis to our benefit in the post-Brexit negotiations, and to hasten the demise or radical reshaping of the EU project itself? Should that be an objective of British policy? And John May asks, what role can deregulation play alongside fiscal and monetary policy?
Well, I don't agree with us trying to damage the European Union. I think we're making a very important contribution to the possible success of the European Union by withdrawing, because I think the only way they can make a success of their Euro-led project is to have much more political integration. They need a more integrated treasury and a more integrated budget. It's taking quite a lot of time to bring that about, because there is a wide variety of views on that. But I think Britain getting out of the way has made that a bit easier for them to try and resolve. And as our near neighbours, I wish them every success and I hope they resolve it. No, we shouldn't be trying to make life more difficult for them and for their proto-union. What I think we must do is take advantage of the freedoms and the independence that we will be gaining at the end of this year. And I'm a very keen advocate of the strategy of the government to get on with negotiating free trade agreements with the United States of America, with Australia, New Zealand, and with the Trans-Pacific Partnership and with Japan. They're all very willing counterparties. They're very keen to get on with the talks. The talks can be done using remote technology, because it's obviously more difficult to fly around the world at the moment, but all these things can be done by conference calls and video conferences and so forth. And I think that will hurry the European Union up to realize that we're serious about leaving at the end of the year. And the European Union then would be more likely to want the kind of free trade agreement we're very willing to offer them as well. And I think that would be a happy outcome for them and for us. But I think without making rapid progress elsewhere around the world, the European Union will want to try and delay us, which would not be in the interest of either party.
And what's your view on China? Obviously, there's been a lot of talk about the impact of in the wake of the virus, that a change in relationship may be needed.
Well, I am one of those who thinks we need to be very careful about allowing China too much access to our sensitive areas with their technology. I think we do need to have more of that technology made at home or made by close allies and friends, and to work in collaboration with them, because it does have implications for defence and security, as well as for wider economic interests. And so, yes, I think we do need to firm our position a bit on China and realise that China has strong economic interests in dominating various markets, and China is dominating the rare earths market. It's trying to dominate battery technology for electric vehicles. It's obviously developing a very strong position in mobile and smart telephony. And we need to make sure we in the West have our own resources and sources for these modern technologies, which are going to play such an important part in our lives. So I think one of the consequences both of the COVID-19 crisis, where faraway suppliers often prove more unreliable, and of the big debates initiated by the United States on security, is that there is going to be more local and allied sourcing for quite a few of the things we need.
So David Harris, who's been very patient, because he asked this in the chat right at the beginning of the thing, and has now asked it again in the QA. Do you see the monetary policy, Ray COVID-19, but also QE, impacting negatively on retirement savers and pension funds? And do you see any strategies or tactics to mitigate the effects of a prolonged, long-term, low-interest rate environment? I mean, I know this is something that we at the CPS and others are really worried about. the impact on savings has been and continues to be fairly huge.
Well, there will be an impact. There is an impact. We've seen a progressive impact on pension funds from this era of quantitative easing stretching for more than a decade now, with very low bond rates, because it does mean, given the way that pension funds are valued, that the liabilities appear to be very great because they're valued around the interest rate and the cost of the bonds to supply the necessary income. So that is a problem for pension funds. There are some offsets because clearly also pension funds own a lot of bonds and they've been making more money on their bonds as the prices have gone up and the interest rates have gone down. And many of them now have adjusted and have learned to live with the fact that you're going to have highly priced bonds on low interest rates. And that has just been given another twist by the latest lurch down in interest rates. So I don't think it's a new problem, Robert. It's just a continuation of a problem that many people in the industry have partial solutions to and are learning to live with.
And again, we've got a couple of overlapping questions. One submitted earlier by Paul Goldsmith, a medical professional and CPS author, asking what monetary policy levers have other countries successfully used to promote regeneration in unbalanced geographies? So, is there a monetary angle to levelling up? One of the other great issues. And Luke Newman has asked quite a sort of similar question. Will the sheer volume of the amount we are likely to borrow to deal with COVID risk those government schemes in the pipeline, such as HS2, 5G, etc.? Or should we go ahead with these projects anyway, considering the low interest rates? Are they critical politically to Boris Johnson's first term? Would under-delivery represent a political risk?
Well, monetary policy can certainly help spread prosperity and investment around a country or a monetary area. And it does that by getting the right balance of interest rates and the opportunity for commercial banks to extend more credit sensibly. Monetary policy can't target and it can't make sure that a depressed part of a country benefits more than a successful part of a country, but it can create conditions in which there is sufficient credit for the investment to spread more widely into those projects that will be of most benefit in the areas that have suffered a bit. And so I think, if you look at the last few years, the United States of America have been rather more successful with its monetary policy than either the United Kingdom or the Europeans, because it had allowed a little bit more money growth, and then combined with the Trump tax cuts, it was doing extremely well at promoting employment and growth in America before the virus hit, whereas our monetary policy from spring of 2017 onwards was too dour and was actually slowing our economy rather badly at a time when we should have been going for rather more growth to encourage that credit and those investment projects around the country. As to big investment projects, I think good investment projects at these interest rates can make quite a lot of sense. You're not talking to the right man about HS2, because I was one of those who, when the original decision in principle was made, I voted no. Because I thought there were better economic projects than HS2.
And presumably the economic case, in your view, has not got any better since then as the costs have increased?
No, indeed. But I think that's an old argument, and you can't keep on revisiting these things, and the government will do what the government's got to do. It's very well-intentioned investment. A lot of people in the North think it will make a big contribution. So may it do so. I'm all in favour of spreading the investment around. I'm all in favour better transport around our country, because that is part of the way to get better growth.
So we've only got about 5 minutes left. So if anyone has any questions, please get them in now. It wouldn't be a CPS event without this question from Danny Clark. So John, how do you feel if Margaret Thatcher was in power now? How would she deal with the economic impact of COVID-19, and how would she get the economy growing from this? You are welcome to take the Charles Moore view, which is that he is unable to channel her ghost, and so refuses to answer any what would Thatcher do questions. But obviously,
I would hope that if Margaret were back with us, she'd listen very carefully to what I've just been saying and would be, to some extent, persuaded by my arguments.
But obviously, I mean, what would be interesting was, everyone's been talking about the balance between scientists and politicians. She was famously, our first and only scientist prime minister. I mean, she made that famous speech about global warming because she read the science and was convinced by it.
Well, indeed, and that was Margaret to a T. I mean, Margaret was incredibly hardworking. She fitted a lot into her very long days, and she liked a good read. And when I was working closely with her as a principal policy advisor, she would read the things I submitted, and you were as good as your last piece of paper. And if you made a cogent argument, she might be persuaded by it, or she'd want an oral argument to test it out, because she wanted to make sure before she agreed to anything. Sometimes it took weeks or months to persuade her of something because she wanted to test it out. She knew it was a very big call and it needed to be carefully examined. Other times she immediately agreed because it chimed with what she was thinking and had already worked out from her own reading. But yes, it was very evidence driven, and it was very much about the public interest. It wasn't about the Conservative Party or the political game. She was a very good politician, and when she had to deal with the Labour opposition in the political way she could, that wasn't the kind of conversation I ever had with her. I was her policy advisor, and her only questions were, will it work and is it right? And sometimes I would say, yes, well, it will work and it's right, but I don't think it's going to be very popular, or I think quite a few people in the cabinet won't be in favour of it. And she would just regard that as a challenge and say, well, if it's right, John, we have to do it, because she was such a great lady, and she was so dominated in her thinking by what worked, what was right, what did the evidence say. And that, I think, is why she was a great prime minister. And
presumably that, but in terms of, I mean, Danny's actually asked another question about how we can, ensure we remain a growing dynamic economy. Presumably, a dose of the same principles would not go amiss, in your view.
Well, my advice to the government is that they shouldn't move away from the proposition that we've been talking about tonight, which is that the way we get back to dynamic, successful economy again after this nasty, sharp interruption is by promoting an ever more active and successful and enterprising private sector. And that means regarding the heroes and heroines of the National Health Service as complementing the heroes and heroines of the self-employed sector and the small business sector in particular. Because it's in those areas where we're going to see the exciting pace of change. And that means lower taxes, not higher taxes. It means living with a bit of a budget deficit whilst we build up the wealth and the income generation again, which will start to take care of the need for tax revenues. It would be quite wrong to pick on people who have the chance to create wealth and jobs and businesses and tack them too strongly at the very time when you need them to be most successful and most enterprising. And this is a time of huge change anyway. The COVID-19 disaster is accelerating the change, but the digital revolution was with us before COVID-19, but the digital revolution is now sweeping everything before it because most of the answers to how do you work whilst trying to stop the spread of the virus come back to technology.
I mean, I've been sort of making the case that this is in a weird way the best time for this disease to happen, because technology has advanced to the point where we can do things like this. Just imagine being stuck in lockdown without broadband or Netflix and.
No, there's never a good time for something this nasty, but I understand what you're saying, and it has clearly made people much more aware of the technical offer, and it's also meant that quite a few people who felt that the technology was a bit difficult or wasn't quite right for them now have to use it. And so lots of older people are now contacting their families on Zoom or on other competitor products, getting together in a social way without actually meeting. And lots of businesses are discovering that people can work from home, that they can hook into their central computers in their office from laptops and other devices in their living room. And people are learning to live with the fact that the cat and the child might have an opinion on some of their business life, but it's better they're able to work most of the time under regular hours, even if there are a few noises off.
Well, speaking of noises off, I have a 5-year-old who has been informed that at 6 o'clock precisely, his father will go and supervise his bath time and bedtime. And before he batters down the door, I'd just like to say thank you so much for a fascinating conversation. It was really, really interesting. And I certainly learned a lot from it. If anyone's interested or wants to spread the word, we will be making a recording of this available on the CPS YouTube channel. And in the meantime, thank you very much to Sir John Redwood.